Everybody, Robert Klein here again. So today we're going to talk about be your own banker, optimized versus not optimized. So what is optimization? If you're trying to produce as much as possible with the lowest cost, your aim is optimization, making something the best it can be. So who is this presentation for? Well, people or businesses who are putting 50,000, 100 grand, or $250,000 plus per year into life insurance contracts, or people who are using the infinite banking or be your own banker strategy. What will you learn? Well, how to tell if your policy is optimized to the absolute maximum, or how to tell if your policy is optimized to the absolute minimum. So why is this important? Well, the average lifetime deposit into these contracts is anywhere from $500,000 to like $5 million plus. So it's a massive amount of money, and figuring out really how to optimize these contracts is to your benefit. First thing we're going to look at is cash values in year one. A non-optimized contract, what you're looking for is the cash value is going to be anywhere from 0% to 70% of the original amount of money you put into that contract. Versus an optimized contract, you're looking anywhere from 88% to 94% of the original money that you put into that contract. So here's an example, $100,000 a year going in, total cash value in year one is $43,000, and the death benefit is like $1.7 million. So the cash value in year one is 43.1% of the original premium. Now, by structuring it a little bit differently, well, the premium goes to $100,892. And then the cash value goes to $61,800, and then the death benefit goes to $3 million. Well, the cash value component is 61.2%. This is still not optimized. So what does an optimized contract look like? It looks like this: 100,000 or 101,000 in this case. But more importantly, the cash value in year one is $94,702 with a death benefit of $3.74 million. So the cash value in year one, same $100,000, same person, same age, same everything, was 93.2% of the first year's premium. So what you can do, go to your insurance illustration and look at what percentage was lost in the first year to determine, are you optimized or not optimized? So the second thing we want to look at is your payment term. Are you paying this contract to age 90 or even age 100? Or are you locking out the insurance costs in years 20 or over a 20-year period, over a 10-year period? The short answer is you want a 20-year period or a 10-year period. Most of the time it's going to be a 20-year, but you definitely do not want to be on the hook for these contracts for the rest of your life. And you don't have to be. So optimized is 20-year or 10-year, not optimized is age 90 or even to age 100. Minimum payments. So what are your minimum payments per year in these contracts? A non-optimized contract will require you to pay 60% to 100% of the original premium that you put into that contract. An optimized policy or an optimized contract will require you to put 7% to 10% of your original amount as a minimum into that contract. So if you actually have a bad year, you only have to pay 7% to 10% of your original contract. So for example, if you put $100,000 a year in, well, the minimum for a non-optimized contract can be $60,000 to $100,000, where the optimized contract will be $7,000 to $10,000. How about maximum payments? I find a lot of people actually own multiple whole life contracts where they don't need to. They can just originally own one with options of actually increasing the amount of premium that they could put into the contract. So for example, putting $100,000 a year in generally locks up that contract at $100,000. But if it was set up in a very specific way, you could have a $200,000 maximum. So if you look at the minimum to maximum range with someone putting $100,000 a year, for the example that I'm personally thinking of, that the minimum would be $7,000 a year to over $200,000 a year. So you got massive amounts of flexibility when these contracts are designed in a very optimized way. So how about insurance types? Okay, well, there's three types of insurance types that play into these contracts. There's whole life, term life, and paid up additions. A non-optimized contract is going to maximize the whole life component, minimize term life or have no term life, and have minimal paid up additions inside of the contract. An optimized contract is actually going to have a very low portion of whole life, maximum term life, and by doing so, you end up getting a ton of paid up additions. So the question becomes, well, what is paid up addition? Paid up addition insurance is insurance that's already been paid up. So for example, if you have $1 million of paid up addition coverage, you no longer have to pay for that insurance ever again. So if you're 40 years old, you have $1 million worth of coverage and it's paid up additions. So if you die at age 90, that $1 million gets paid out at age 90 and you never had paid for it again. So optimized contracts, what you're looking for is minimizing the whole life component, maximizing the term life, and maximizing the heck out of those paid up additions. How about ownership structures? What you're really looking for is it owning an operating company or is it owning a holding company? The short answer is you do not want to be owning anything in your operating company. You want it to be held in a holding company. And the main reason is that that cash value is fully liable to the company itself. The lending options. Well, here's TD Bank, Bank of Montreal, RBC, CIBC, Scotiabank. The short answer is these are the best lending options you can possibly get. But what's the problem? Most people only get the lending done through the insurance company. And by doing that, they're paying prime plus 3.5%. Well, if they went direct to a bank, they're paying prime minus a quarter to prime plus 1, maybe prime plus 1.5%. But the problem with the bank is you actually have to qualify 10 years in advance for that type of loan. And many people in the industry don't have a clue of how to deal with banks, so they actually ignore it and only ever discuss how the insurance company is going to qualify for it. So bottom line is, if you have insurance company only financing on your contract, you're not optimized. You actually want to figure out what it takes to get bank financing on your policy. So who is the borrower? This one surprises me because this is actually one of the biggest purposes of this program. So who's the borrower? Is it your corporation borrowing the money, or is the money being borrowed on the personal side? The short answer is you actually want to look at both options. But if only the corporation was discussed, you're not optimized. The reality is the personal side lending against a contract inside of your company is one of the prime reasons of why you're actually acquiring this type of contract. So if it's never been discussed or looked at or really got looked into, you are not optimized. How about canceling your policy? A non-optimized contract, you're going to lose 30% to 100% of the cash value that you deposited into that contract if you cancel it in year one. Well, if you cancel it with an optimized contract, you're losing anywhere from 6% to 12%. And that's actually including the insurance costs that you would have paid. So the short answer is you want to structure your contract. You want to make it as cheap as possible to leave it. How about break-even point? Well, the average break-even point for a non-optimized contract is anywhere from 8 to 12 years versus 2 to 3 years in an optimized contract. So here's an example. Here's $100,000 going in, total cash value of $60,000, and then putting this money in around year 11 of putting this money in, the break-even point occurs for the money that you deposit into the contract. Well, same 100 grand being put into an optimized contract, we start at like 93% in year one, and then by year 3, we basically have all of our cash value back to us. So the break-even point in an optimized contract would look like this. What will we do when we analyze your policy? Well, the first thing, we'll do a comparison. We'll take your whatever current illustration or the illustration that you had, and we'll just compare it against what an optimized illustration would look like. We'll then go through all the components. First year cash value maximization, payment terms, 10-year, 20-year, 90-year life, what the minimum payments are, maximum payments, the insurance types, the ownership structure, the lending options, who is going to be the borrower, canceling your policy, break even. We'll go through all of these components. And when you do all of that, it becomes pretty obvious what you should do and what you shouldn't do. Again, why is this important? Probably because you're going to be spending a significant amount of money into these contracts, and it's probably worth maybe a second point of view on it. What's the next step? Send me an email to robert@robertklein.ca or call me at 778-896-6732. Thank you. Bye-bye.